Apple and Amazon are two of the big headliners in what will be another busy week of earnings reports. Both companies are scheduled to report on Thursday after the bell, so set your timers, get ready. Shares of these mega caps are up more than 50% so far this year. I want to bring in Piper Sandler Managing Director and Chief Market Technician Craig Johnson. Craig, I know what this has been signaling to everybody, but from a technical perspective, where does things stand? You've got Amazon up 59%, Apple up just over 50%. What does this mean?
So, Becky, the charts still look absolutely terrific for both Apple and for Amazon. And again, they've been powering this tape higher. Again, they've been 10% of the overall S&P 500 year to date, lifting the markets. And if you just break apart first the chart of Apple, stock is continuing to trend very well. You're back above 50, 200-day moving averages, still showing good relative strength. Again, we still think there's more upside. And again, our fundamental analyst actually agrees with us as he just raised his price target on it today to 220.
What would be a troubling sign? I mean, is there anything that would tell you beforehand, or what happens if one of these stocks just tanks because there's something people don't like in an earnings report that comes later this week or on a conference call?
Yeah, I mean, the charts do a pretty good job of sort of looking forward, sort of anticipating for us, what we think is going to play out. Right now, I'm not seeing any divergences in terms of momentum indicators for Amazon or for Apple at this point in time. And those would be things we'd be typically looking for. We'd start to see the charts roll over. You'd start to break some uptrends. You start to break some shorter term moving averages. Neither of those things are happening, or any of those things are happening for either Apple or Amazon. And in fact, if you look at the chart of Amazon, we've been stuck in a 3-year consolidation range. And more recently, we just broke above a 200-day moving average. We reversed the downtrend. It suggests to us that there's still a decent upside here left to go for Amazon to get back toward the old highs. And 144 and then 166 would be a couple of levels we'd be watching. But Becky, we're confident that these two companies are going to do well with the report. And we actually raised our technical price objective on the S&P 500 this morning to 48.25 from 46.25, which when we said it back in December was pretty controversial, but is playing out like we thought it was going to. And again, there's still more upside for equity markets.
Craig, I understand that the whole idea that you're charting things, you can catch momentum. That works in the absence of any news. But if there were suddenly some news that disappointed the market, I mean, charting wouldn't necessarily pick up on concerns about something that was going to happen on an earnings call, or would it? Because you think that would be kind of out there and floating in the ether before they even said it.
I think there's a lot of very smart investors out there, Becky, and I think a lot of this information gets priced into the market basically real time. Watching shows like this, I think is helpful for the average investors, for professional investors, and there's a lot of smart people baking in a lot of different scenarios. And the charts do a pretty good job of helping steady people's sort of emotions and also sort of put it into perspective for people that when you're seeing these stocks making a series of higher highs and higher lows, you're back above 50 and 200-day moving averages, tells us that there's something constructive happening. And while you may have some shorter term setbacks, the longer term trend is still higher. And I think that's where we've sort of got to keep and pay attention to.
You're talking about more broadly the markets, right? You are raising your year-end price objective for the S&P 500 at this point, too.
We are, absolutely. We still think there's more room left to go. And in fact, Becky, one of the things that technicians like to look at is all-time new highs. And if we go through and you look at the S&P 500 year to date, we've got about 15.7% of all the stocks in the S&P 500 that have made an all-time new high year to date. And I know when I have conversations with investors about these stocks making all-time new highs, they're kind of like, what? They still have a mindset right now that things are bad, that earnings are not going to come out well, and they're concerned, obviously, about the Fed. But at this point in time, you got 15.7% of all stocks in the S&P 500 making an all-time new high, which suggests to me that there's still more room for equity markets to run, Becky.
Yeah, and just to put this in perspective, the S&P closed at 45.82. Your earlier price target was 46.25, so it was getting close. But now you're saying by the end of the year, you're looking for 48.25.
Correct. By year end, we're looking for 48.25. And again, there's so many stocks that are making new highs. It's pushing the overall breadth of this market higher. And one of the other things to keep in mind is there's been such a focus on the Magnificent Seven. But when you actually look at the percentage of stocks in various industry groups that are making the new highs, believe it or not, it's led by industrials and consumer cyclicals. And third on the list would be technology. So this is a broader rally, Becky, than I think a lot of investors are thinking about. And again, we've had a tremendous amount of pushback on our call throughout this year. But again, when stocks are doing what they're doing, price action tells us something significant is playing out, and we want to stick with that trend. And that's what's happening right now.